So what I'm going to present today is a paper that is joined with Ben Marrow, who is a former PhD student from Chicago who is at Citadel. And what we are, let me start off by just giving a little bit of background where we're kind of coming from in this project. And what we're interested in is basically discovering, sources of cross-sectional stock return predictability. And if you think about the traditional approach that's being used in most of the literature, is that a researcher looks at a historical data set, takes the full sample that's available ex post, and does an in-sample analysis of those historical returns. And then for example, average factor returns or average cross-sectional regression coefficients in those studies are then used as estimates of ex ante expected returns that a rational investor could earn. And there is some issues, or first some examples of this. There's not this huge factors of literature, and so if you look at those studies that are here, it's a subset of those that Chen and Zimmerman look at. Most of those sort of fall into this classic approach where they just use whatever data is available at that point in time, construct average returns, and then use this as an estimate of what the expected returns are, with the notion that these expected returns would be also earned going forward in similar ways as in the past. Now, with this classic approach, there are at least two issues with that. The first one is that predictability patterns may change over time. They may decay, maybe also new ones may emerge. And some of this may have to do with technology, some changes of the investor composition, and lots of other things like that. And also learning by investors. And then learning by investors on its own also has an additional kind of effect, which is something that earlier theoretical studies have already analyzed, which is that when you have an economy in which investors are learning, for example, learning about how to forecast firms' future cash flows, then when an econometrician comes in and looks at the returns that are generated in that economy, and looks at these returns ex post, they can appear predictable ex post, even though they're never predictable and exploitably predictable to an investor ex ante at the time when the investors made decisions and based on the data that was actually available to an investor in real time. And so just one example of this is studies that have looked at post-publication decay of anomaly results. And in this chart by Chen, Lopez, Lira, and Zimmerman, you can see that the returns of these anomalies that they are looking at are much, much lower after the publication date, shown by the vertical line there, than before, right? And this is sort of can be a consequence exactly of those effects that I just talked about here. All right, so this is kind of the background. Now, in machine learning, there has been a little bit of progress on this, in the sense that the machine learning literature in empirical asset pricing often focuses not just on in-sample fitting, but actually on out-of-sample, at least pseudo out-of-sample prediction. And it sometimes also, these papers then allow for changes over time, but in a somewhat little bit ad hoc way. There may be a rolling estimation instead of using an expanded window estimation or something like this. But the models are really not designed to address these issues with evolving markets and with learning of investors, but are maybe at least to some degree allowing for those changes, but are not really designed for that. And so what I want to show you today is an approach that tries to tackle this. It's an approach that is meant to discover and track return predictability in real time. So at every point in time, only doing something that an investor could actually have done with the data available at that point in time. We want the method at every point in time to also then give us an assessment of the uncertainty we have about that return predictability going forward. And we want to, and this is a point I'm going to get to in more detail very soon, we want to do this in a flexible way without forcing artificial simplicity and sparsity on the model of expected returns. And I'll be more clear about exactly what that means. Yeah. But for now, just a brief kind of roadmap of how we're getting there. One element of the approach will be a Gaussian process regression approach that's going to give us basically at every point in time posterior beliefs about the expected returns in the cross-section purely as a function of the data that's available until that point in time and the prior beliefs that also go into that approach. And these prior beliefs, we're actually going to estimate in a data-driven way, or more precisely, the parameters of these prior beliefs by using an empirical Bayes approach. And what this is going to do is basically it's going to induce some data-driven shrinkage on the posterior, and this helps first of all to make your estimates less sensitive to estimation errors, and so for that reason should do better out of sample. But it also has a particular role here for addressing this issue about investor learning. So Ian Martin and I, in an earlier theoretical paper, showed that if investors are learning about how to forecast future cash flows, and as a consequence, returns observed by an econometrician ex post are kind of contaminated with effects of investor learning and are not truly exploitable patterns, then an empirical Bayes approach kind of imposes just about the right amount of shrinkage to, in some sense, shrink away those excessive predictability patterns generated by learning. And now the third element here is that we're going to introduce into this Gaussian process regression empirical Bayes method an exponential weighting of data in the estimation, which allows us to allow for some decay, emergence, re-emergence of anomalies over time. Yeah, basically allow for things to change. All right. Now, if you want to do that, we basically want to take the perspective of an investor who could have done this analysis at some point in the past, and we don't want the investor to have some knowledge that an investor at that point in time wouldn't have had. So, for example, we don't want the investor to have knowledge of published academic studies about anomalies that were published much later, right? So what we therefore don't want to do is we don't want to now start our analysis by looking at stock characteristics that have already appeared in published asset pricing studies, because they are already an exposed selected sample. They have been obtained by researchers that have already studied the data. And so an investor, let's say in 1960, wouldn't have known about those kinds of things, right? So we want to be kind of hands-off in that sense, that we don't want to give our approach here the knowledge of these studies that were published. What we would ideally like to do is, but we're in some sense doing is, we're gonna pick a class of predictor variables, but we're not going to do any pre-selection of predictor variables within that class. And so in that sense, we're trying to minimize this problem of look-ahead bias. The class of predictor variables we're going to use here is the class of predictors that are basically linear predictors that are a function of monthly past stock returns. And essentially kind of the entire history of monthly past stock returns, we're going to cut it off at some point because there's not that much data available, and so we're going to go all the way to 120 months. Right? So this is sort of the set of predictors that we're going to work with for every stock at every point in time. There's a history of past monthly returns that we're going to take all the way back to minus 120. Now, the way we think about this approach here in this paper is it's kind of a study trying to use this approach in a simple, manageable setting, but you could certainly extend this possibly much further. For example, by using all of compute-style accounting variables or something. You would have to make some tweaks to the approach, as you will see later, but at least conceptually, what we're doing here in this paper could be extended a lot further. But what I want to show here is basically do this in a simple setting where we can sort of kind of also nicely see about what's going on when we construct those estimates. All right, so that set of linear predictors I've described basically means we're going to focus on past return-based anomalies. And if you look at the literature there, there's of course many studies that have looked at various different versions of past return-based prediction. The Bond and Thaler in 1985 looked at 3 to 5 year reversals. Jagadish 1990, 1 month reversals. Jagadish and Titman focused on 3 to 12 month momentum. And then the Heston-Sutka paper, which is I'm going to mention again later, has looked at a kind of a weird, in some sense, odd correlation pattern where returns next month are predicted by the return 12 months and 24 and 36 and 48 months ago, and so forth. But if you think about all of these studies, the way the predictor was picked is kind of ad hoc, right? So why did the Bond and Thaler look at 3 to 5 year reversals? Why not at 12 months? Why did Jagadish and Titman look at momentum up to 12 months? Why not longer to 24 or something like this? It's kind of ad hoc, and we don't want in our approach we don't want to make this ad hoc selection. We want to let the data speak about how to best combine all of this information from all of these 120 lags that we have for every stock. Okay, and so we basically want to, at the end, get to what at every point in time, a Bayesian observer would have discovered in real time with the data that was available up to that point without selecting based on exposed information that is available in published studies and so forth. Okay, related literature, there are some connection points here that I want to mention. So empirical Bayes estimation has been done in a number of papers recently. I guess the main difference between what we're doing here and in these other papers is that these other papers used exposed selected characteristics in the sense that they're focused on characteristics that have appeared in published studies, which is exactly what we don't want to do here. There's also work on data-driven shrinkage and studies that have not done this exposure selection of predictors, but have instead worked with a huge class of predictors, kind of like what we're trying to do here. The key differentiation is that we're going to think here about how to optimally smooth the signals from different predictors and how to think about optimal downweighting of past data. And our approach is also going to give us at every point in time a full predictive distribution of returns. So we're going to be able to compute things like, an ex ante Sharpe ratio based on the predictive distribution and so forth. So let me show you how we go about the analysis. The first step is to construct what we call lagged return portfolios. So we take, first of all, individual stock returns and subtract the cross-sectional average mean at every point in time. And this becomes these excess returns X. And then we use those excess returns to construct these so-called lag portfolios, where we take the vector of excess returns at every point in time across all of these firms, and then employ a weight vector. And the weight vector is basically the slope coefficient in a regression of the returns at time t on returns at time t minus k, where k is the lag. So for example, lag 1 would be, we look at the regression coefficient when you regress firms return this month on the previous month and doing this regression in a cross-section. And as is well known, you can interpret cross-sectional slope coefficients as portfolios, and this is basically what we are doing here, right? So these are basically cross-sectional regression slope portfolios that we are working with. And we are doing this for all of these 120 lags. So for each lag, there will be one portfolio. There will be a lag 1 portfolio, lag 2, lag 3, all the way to 120. Oops. Okay, and now about the interpretation of these portfolios, if you think about a linear projection, where you just take excess returns this month and you project them in a multivariate regression on all of these lag returns. We have a special situation here in the sense that returns have very little correlation across those lags because returns are not entirely but close to being not autocorrelated. And so in this sense, the coefficients that you're getting in this regression with multiple predictors are pretty much the same slope coefficients that you get if you just put in a single predictor at a time. And so you can kind of interpret the average returns of those lag portfolios that we are constructing as kind of also the coefficient that you would get in that kind of, from a Macbeth type regression if you were to regress excess returns on all of these lags together. Just to show you how the data looks like, this is not really our analysis yet. Let me show you what you get in our full sample if you just take the average returns of these lag portfolios that we just constructed there. And you see the usual kind of anomalies that are showing up. At the first lag at the very left, you can see this is strongly negative. This is the Jagadish 1990, 1 month reversal effect that shows up there. Then from lag 2 to 12, it's very positive. This is the Jagadish and Titman momentum. Then in red, you see all of these negative values. That's reversals at longer lags. So that's the Bond-Taylor. And then you can see at, excuse me, at like 24, 36, 48, 60, and so forth, you get these positive spikes. And that's the Heston and Sutka, this kind of, seasonal autocorrelation effect that they documented. All right, so let me go into our approach now. So first, a little bit of notation. I'm now going to denote the expected return of one of those lag portfolios. So the portfolio with lag k is going to be mu as a function of k. So the expected return as a function of the lag. And so we can think of the realized return of a lag portfolio as its expected return plus some noise. And now the approach we're going to use is going to be a Bayesian one. And the first step is to define how the prior beliefs look like that we basically have about these expected returns here. And we're going to model this as a Gaussian process, which essentially has two key properties. We're going to say, if you think about the expected return of these lag portfolios, the first important thing is we're going to think of them as zero mean under the prior beliefs. So under the prior beliefs, we're not taking a stand on whether a momentum type effect or reversal type effect would be more likely at a particular lag. We want to let the data speak about this, right? So in that sense, the prior is agnostic about this. And the second thing that this Gaussian process approach allows us to incorporate is what I call here covariance, which is that the expected returns at different lags can be correlated under the prior beliefs. So basically, if the investor thinks about, before seeing any data about the expected returns of lag portfolios that are, let's say, in a close neighborhood, the investor could think about these as correlated in the sense that if one has a higher expected return, the other one is also likely to have a higher expected return. And we let that covariance be a function of the lags of these two portfolios, where we will later basically then use the distance between these lags as something that goes into the covariance function. Okay, so these are the prior beliefs, and then for the Gaussian, for the noise, we're going to assume it's Gaussian, and there's also going to be covariance, and I'm going to tell you later how we model that. Okay, now really a key part of this approach is how to now model those. Let me just go back to show you where this comes from. How to model these covariances that show up in this Gaussian process here. we're going to give this three components. And let me first start with the last one. So this kappa, that's a function of these two lags, is basically the standard Gaussian processing where we allow there to be a correlation, and I'll tell you in a second how we specify that. But there are two elements we introduced where we did take a little peek at the data in some sense that we are introducing here. And it would be maybe kind of nice to get rid of this by introducing yet another layer of priors that would allow us to do this in a hierarchical kind of setting to allow for these effects that we want to incorporate. But we opted for the simpler approach of incorporating it directly into the prior here. And there are two things that are just so strong in the data that if you don't allow the prior to kind of allow for that, you're not really going to fit the data well. And these two things are that these 1 month reversal effects in some periods are just so incredibly strong. So if you don't allow for that this first lag to be somehow special, then it's really not that working that well in terms of fitting the data later in the posterior. And so we are allowing for what we call microstructure effects at lag 1. Lag 1 is kind of special in the sense that we allow there to be an additional peak of the variance under the prior beliefs at that first lag. And the same then for the season, this Hessner and Satka seasonality effect. So we are allowing for additional spikes in the prior variance at these lags that are multiple of 12. And you'll see this later when I show you a chart with the posteriors. You will see those spikes basically also popping up in the posterior. And then the last step is to model that kappa function back there, which now is the regular Gaussian process covariance between lags, where the covariance is going to depend on a distance, and this comes in through a kernel, but a kernel basically models the covariance as decaying with greater distance. And the key thing is that there is a hyperparameter tau that will now determine how that covariance looks like. Is the covariance going to be substantially different from zero only in a very small neighborhood around a lag, or is it going to be much more spread out? So here you can see, just for illustration, how these a prior distribution would look like. We have basically gone to the set some parameters for the prior distribution, and then took 20 draws from that prior distribution, right? So you can kind of visualize a little bit the ex ante randomness that's implied by that prior. And what you see there is, well, first of all, everything is centered around 0, all of these 20 draws. So for every lag here, all the way up to 120, and this comes from the fact that we gave the prior 0 mean. And then you can see if you follow one of those lines, it's kind of persistent to some degree. This is where the covariance in the prior comes in. We allow the expected returns under the prior of lags in a neighborhood to be correlated. And this is why this looks persistent, right? When you look across lags here. And then you see these spikes at lag 1. There are these big amplitudes, and at lag 12, 24, 36, and so forth, which are these microstructure and seasonal components that we allowed the prior to have. Okay, so now we have the prior. Next step is the posterior. A little bit of notation. First, I'm going to now take these mu k's for all of these 120 lag portfolios, and I'm going to stick them into a vector bold mu. I'm going to take all of these covariances in the prior beliefs for different pairs of lags for these 120 portfolios. I'm going to stick them in a matrix bold psi. And the noise covariances are going to go into sigma, also bold. And now we get, by combining the data on the realized returns of these lag portfolios and the prior beliefs, we get posterior beliefs. And the key thing is what's happening here with the posterior means, which you can see down here. So the posterior means clearly depend on the average realized returns of these lag portfolios, which are these F bars here. But there's also, shrinkage going on through this, term here. And the shrinkage, as you can see, depends on psi, which is the um, covariances that are showing up in the prior beliefs. Okay, and basically what's going on with that, the effects of the prior and the posterior, there are kind of two key effects. The first one is when you have prior beliefs that the expected returns of portfolios in some neighborhood are highly correlated, this is going to induce some smoothing in the posterior because now, through Bayesian reasoning, one is saying, well, if the expected returns in a neighborhood are very similar, likely under the prior, then I should be using data from all of them kind of combined to estimate expected the posterior means in that region. Right? So this is going to induce some cross-sectional smoothing across those lag portfolios if they are somewhere in a neighborhood in terms of lag. So the 7-month lag portfolio will then be smoothed a little bit with the 6 and 8-month portfolio and so forth. So this is one important effect. The other important effect is that the variance is finite, and if it's relatively small, then it's going to induce a lot of shrinkage, right? So the smaller the prior variance, the more precise are the prior beliefs, and so the more weight there will be on the prior beliefs, which are centered around 0, as opposed to what the data says, right? And so the data will be shrunk more strongly towards 0 if the variance in the prior beliefs is small. And the hyperparameters that control these two types of effects is the tau for the cross-sectional smoothing and this xi parameter for the magnitude of the variances of the prior beliefs. Okay, and now the key question is these hyperparameter values that I just talked about, what value should they take, right? So how much should expected returns be shrunk towards 0? How much should expected returns be smoothed cross-sectionally across lag portfolios in a certain neighborhood? And what we are doing there is we use this empirical Bayes approach. We are basically saying, we're going to look back at the data and we're going to do data-driven estimation of these prior hyperparameters. But the important thing, of course, will be, since we want this all to be something that an investor could have done in real time with the data available until time t, we also want to do the data-driven estimation of these prior hyperparameters only using data up to time t. Yeah? And I'll explain in a second exactly how we do it. But roughly speaking, what we're going to ask is, which hyperparameter values would have made the observed data until time t kind of most likely, right? And that's the hyperparameter values that investors then is going to use to construct the posterior for t+1 returns. And then once t+1 has been realized, the investor is going to update their views about what these hyperparameters are based on using one more observation of data. Okay, and then what's relevant here is something I mentioned briefly earlier, which is that Ian Martin and I in an earlier paper have shown that this empirical Bayes approach is really useful, especially when you're thinking about a situation where investors are learning about the data generating process, because if you do this in this empirical Bayes approach where you ask, which hyperparameter would kind of explain the data best in the past, you're implicitly kind of shrinking away the predictability that's induced by learning, the in-sample return predictability that's induced by learning. And so you're not confusing then in-sample return predictability induced by learning with out-of-sample return predictability that you're trying to capture. Okay, so how does this empirical Bayes approach work? We have several hyperparameters here. The xi, which controls the shrinkage, the tau, which controls the smoothing, and then also M and S, which are these extra spikes that we allow in the prior variance for this microstructure and the seasonal effects. And the way the estimate is basically by maximizing marginal likelihood of the data up to time t, right? And so at every point in time t, this is something that an investor could have done with the available data that was available until that point in time. Okay. And now once we have fixed the hyperparameters, we have prior beliefs. Combining with the data gives us posterior beliefs. And the way I'm going to show you soon the results is I'm going to summarize basically the posterior distribution in terms of empirical based t statistics, roughly speaking, where I'm going to take for a given lag portfolio the posterior mean. I'm going to divide it by the square root of the posterior variance to basically construct something like a Sharpe ratio. Sorry, like a t statistic. Okay, but first, before I show the result a little bit more, we can also do or calculate a predictive distribution, basically using the information from the posterior distribution and then also the sigma, the noise distribution. And one thing we can do with a predictive distribution is we can construct an ex ante Sharpe ratio implied by the predictive distribution, basically taking the posterior means, taking the predictive covariance, and then using this to construct a Sharpe ratio. And we can then also use it to construct an out-of-sample mean variance efficient portfolio return, basically saying, well, if you construct the mean variance efficient portfolio weights based on a predictive distribution and then apply them to next period's lag portfolio returns, then we get a mean variance efficient portfolio return. We can look at how this looks like in terms of performance. The last bit I haven't yet told you about is how we get the noise covariance matrix. Basically, what we're going to do there is impose a little bit of structure, but for the most part, these lag portfolios really have very small correlations. So even a diagonal covariance matrix would be kind of okay. But there's a little bit of correlation across very close by neighboring lags, and so we don't want to introduce too many degrees of freedom in that covariance matrix, but we allow for a little bit of correlation across the first two lags by giving this a banded turbulence structure. But this doesn't really play much of a role here in the analysis, actually. Okay, so let me show you results. I'm first going to show you results from the perspective, basically, of an econometrician that uses this approach, who believes in a time constant expected return function. And the second one that I'm going to show you later is now how this would look like if the econometrician doesn't believe that expected returns are constant, but instead believes that expected returns are drifting, which means that old data is not necessarily all that relevant anymore for estimating what currently are ex ante expected returns. So the second step will then involve some downweighting of data in the past, and I will also explain how we do this. And then if there's time, I can talk about some applications of this whole thing to some other questions. Okay, so first, let's do this with the assumption of time constant expected returns. So in this case, the econometrician who is using this approach would say, well, data 30 years ago is as informative about next period expected returns as the data from last year. And so I'm just going to use expanding windows in order to calculate those mean portfolio returns that go into the construction of the posterior distribution without any downweighting of past data. Okay. And in some sense, this is this kind of belief that there's a time constant expected return function is consistent with the practice in most empirical asset pricing studies where there's no explicit attempt to account for possible changes over time in how expected returns may be changing. Yeah? But we can ask some useful questions with this, which is we can ask, well, would an econometrician following this approach, which is kind of, real-time implementable, which has not exposed selected in an ad hoc way or based on subsequently published studies, what the predictors are. And so it's kind of a hands-off approach that lets the data speak. Would this econometrician have discovered uh, the same anomalies that academic studies have discovered in a way that is now, kind of robust to this, exposed selection problem? It's also robust to, since it's, all Bayesian, it's robust to the multiple testing problem. And it also employs shrinkage that accounts for there possibly being in vessel learning, and shrinkage, as I've explained, kind of, takes those effects out in some sense. All right, let's look at this. So I'm going to show you the results in terms of charts like this, and let me spend a bit of time explaining what this shows. So focus at the very top at the beginning, 1950. And if you go across here, what you basically see here is the cross-section of posterior t-statistics from the posterior distribution for those 120 lag portfolios, where lag 1 is at the very left and lag 120 is to the very right. Yeah. And you can see at lag 1, if you look closely, you see it a bit being a bit green, kind of bluish. This means that at that point in time, the econometrician using this approach would have kind of discovered already the 1-month reversal effect. That's already showing up there with a pretty high posterior mean relative to the square root of the posterior variance. If you look further to the right, beyond lag 1, it's kind of all grayish, which means that the posterior means there are quite small relative to the square root of the posterior variance. And so essentially, the econometrician wouldn't have detected any other anomalies at that point in time. But if you now go down and proceed through time, let's say by 1970, you can see that now, first of all, the 1-month lag portfolio is now very dark blue. So this is, with a high degree of statistical confidence, the econometrician would say here, yes, there is a 1-month reversal effect. To the right, up to lag, 8, 9, 10, there's now a momentum effect showing up, relatively strong. The 12-month lag itself is also very strong here. It's kind of standing out. This is this, Hessner and Satka seasonality effect that then shows also up at lag 24, 36, 48, and so forth. And then these green areas that are emerging there, this is the long-term reversal effect that's now starting to appear. You can basically see that that effect would have been discovered already in the 1970s. And so if you think about where de Bond and Thaler came in with their study and their sample, this was kind of in the early 80s. And by that point in time, our econometrician here would have discovered, even stronger long-term reversal effects. And this allows you to conclude that, the Bond and Thaler long-term reversal effect is not something that was exposed data mined or based on, ad hoc selection that generated this. But it's something that this econometrician using this Bayesian approach and being totally hands-off about the predictor selection and letting the data speak, that econometrician would have discovered the same effect and would have actually discovered it quite a bit earlier. And the same is true also with the momentum effect, right? I have also circled here the sample and date and the lag range that Jagadish and Titman used, and this kind of momentum effect would have been apparent in the data to our econometrician using this approach here a lot earlier than the published study by Jagadish and Titman. Okay, and now if you use this expanding window approach, then because you're always using the data all the way back to 1935 here in this analysis, you would even at the very end you would still kind of diagnose a very strong one-month reversal effect, very strong momentum, long-term reversals, and so on. But a key question now is, well, would that picture change if you allow for the possibility that things may be changing over time, right? That expected returns in 1980, ex-ante expected returns may not be the same as ex-ante expected returns in let's say 2020. And this is now the next step, basically allowing for drifting expected returns. And the way we introduce this here is in a pretty simple way. You recall that in the construction of the posterior beliefs, we had these average lag portfolio returns showing up, and they get combined with the prior beliefs. And in the expanding window approach, we constructed those F bars with expanding windows. And so instead of expanding windows, we're now going to use exponential weighting when we construct those F bars. So there's going to be some exponential weights here. This new that's is defined here. That's basically going to allow for some downweighting of past data, and how much downweighting there is controlled by this delta coefficient or this delta parameter. Right? So this gives us one additional hyperparameter that we have to estimate. And the way we do this is, again, in the spirit of an empirical Bayes approach, in a data-driven way, by at every point in time t looking at which delta would have in some sense done best in the past. And concretely, the way we do this is by asking which delta would have given us in the past posterior means with the smallest mean squared error in terms of forecasting next period lag portfolio returns. Yeah? So again, this is something that at every point in time an investor could have actually done by looking just at past data, and it gives estimates of this delta that then will of course change at every point in time. As new data comes around, the investor is going to come up with a different delta. Okay, and so here's now the picture, how the picture looks like when we allow for this drifting in the expected return function. And as you can see, it's kind of quite different. At the beginning, it doesn't look that different. So long-term reversals, kind of show up somewhere around 1970, and they are still quite strong by the time Dupont and Thaler did their study. But then it kind of fizzles out, except for at the very long end of these long-term reversals, and a little bit at the short end that kind of keeps popping up again. But then around 2010, then they completely fizzle out. There's nothing there anymore. It's all gray. And for momentum, it's kind of somewhat similar, somewhat different story in the sense that momentum keeps going quite a bit longer, but then around 2010, it also starts to disappear. And 1 month reversals at the very left end, you can see they also get weaker after 1990 and then kind of fizzle out as well. So it's in the later years, you get a drastically different picture from this analysis with drifting expected returns than from the expanding window analysis that implicitly assumes constant expected returns. Now, one question that comes up with this now is, well, are these actually good, in some sense, giving you a good guidance on what future returns are going to be? It could also be that these posterior beliefs that we're constructing here, they're just not providing very good forecasts, right? And so it would be nice to have a check for this. And the way I'm gonna do this in the next figure is I'm basically going to take every cross-section of posterior means. Let's say in the year 2000, I take the cross-section of all these posterior means for these 120 lag portfolios, and I'm gonna regress next period realized returns against those posterior means in the cross-section. And then we get a slope coefficient. And if the posterior means are a good forecast of future realized returns, we should be getting a coefficient of 1 or something that's close to 1. Okay, and then we can do this every period and basically asked, what is the slope coefficient? Is this a slope coefficient that is close to 1? And here's what we get. Um, these are 5-year moving averages of those slope coefficients. And, of course, there will be, some estimation noise that will make those, move around. But you can see until around, 2005 here, the end date of the window in 2005, the values actually were pretty close to 1, and we're kind of, cycling around 1, which means that these posterior means are actually pretty good forecast of future realized returns. Now, around 2005, it starts to decay. Even then, it's still taking average values of around 0.5 on average in the subsequent years. But of course, also recall that these are now the years when predictability really gets weak. And so you're also working with predictive signals that are really weak. So it's, not that surprising that at that point in time, you're also not getting a slope coefficient of 1 anymore because there's really almost no signal anymore. So you're kind of regressing noise on noise almost. Okay, but bottom line, these posterior means actually seem to be pretty good forecasts. And you can also look at Sharpe ratios, right? So the nice thing about this approach that gives us an entire posterior distribution is that we can construct an ex-ante Sharpe ratio. And this now allows me also to look at how does this ex-ante or predictive Sharpe ratio actually line up with subsequently realized Sharpe ratios. And this plot shows this here in terms of 10-year moving averages, where blue is the predictive Sharpe ratio that comes out of the predictive distribution, and red is the realized Sharpe ratio. And in the same 10-year window. And you can see, they are of course not exactly on top of each other, but the magnitudes are sort of roughly in the right ballpark, right? Very different, in contrast, is the in-sample Sharpe ratio. If you just at every point in time looked back and said, what is the in-sample Sharpe ratio of these 120 portfolios, you would get the yellow line. And this is, of course, way out of line. The in-sample Sharpe ratio from the past would be a pretty bad guide to the Sharpe ratio that you can earn in the future. Okay, I only have, I think, 2 minutes left, so let me focus on just showing 2 charts from these applications. The first one is one could, ask how do the publication dates actually line up with what comes out of this analysis with drifting means. And what's kind of interesting there is if you look at the Bonner Thaler in 1985, the publication date was around the time that's denoted here with this area that around 1985, and the study was kind of published just around the time when the effect actually mostly fizzled out. For momentum, Jagadish Chitram in 1993, it lasted a little longer after the publication of the study, but also eventually fizzled out. And Jagadish 1990, after the publication date, pretty soon the 1-month reversal effect gets quite a bit weaker, and then also fizzles out, right? So this is another thing one can do now with this type of analysis that allows for drifting expected returns. You can link this to publication dates in similar ways that some other studies have done. And the last thing I wanted to show you, let me just show you the picture for this, is actually, yeah, I skipped over it here. This one here. There's always this question, is momentum and reversal kind of arising from the same underlying, for example, behavioral phenomenon? And if that's the case, then when you see more momentum, you should probably also see more reversals. And with our posterior distributions on posterior means, we can kind of now look at this in every period. We can say, if in this period you have stronger momentum effects, do you also have stronger reversal effects in that same period? And then we can track this over time. And so kind of splitting these posterior means in terms of cumulative momentum effects and reversal effects You see here in this chart that in most years this actually lines up, except for a period in the 1970s and early 1980s when there was a big divergence there. But in all of these other years, it looks like when momentum is strong, you also tend to get stronger long-term reversal effects, which kind of hints at the possibility that these effects may be coming from a similar underlying source that generates both of them at the same time. All right, but I'm out of time now, so let me conclude here. So what I've shown you is that this Gaussian process regression and empirical Bayes approach allows you to track ex-ante expected returns over time in a way that adapts to evolving markets, allows for investor learning. And when you look at the results, you see that there is kind of dynamic decay and sometimes also emergence or re-emergence patterns. And all of this was with just past return-based anomalies, but conceptually, one could also try to extend this now a lot further by looking at a much broader set of stock characteristics beyond past returns, right? Where you then would have to think about, expected returns as a function now of a much, much larger set of characteristics, not just this lag that we work with here. And you would also have to think about how to model prior covariances as a function of vectors of stock characteristics rather than just lags as we did here. But conceptually, this may be something that's possible, and maybe the key question is how to make this computationally feasible. There will be some work there needed, but conceptually it should work. All right. Thank you.
So thanks very much. The audience was surprisingly quiet on this talk. I guess no one wanted to challenge the approach. But anyway, at this point, we'd like to invite anyone who wants to unmute themselves and ask any questions that they have. You don't need to type them in the chat. You can just use your microphone. I will say something that there was a question from Dima at the middle of the talk, and I thought it didn't need to be answered at the time. So I didn't interrupt you. And I actually think it was answered by slides 23 and 24, but I'll let Dima re-ask it if he doesn't agree with me that it was answered by slides 23 and 24. But anyway, if anyone else has a question, feel free to jump in.
Can I start very quickly? Interesting paper. I'm just wondering what's the role of international stock data in this, right? So if we have more data, we get like more precise signals potentially, right? Than with just looking at the US. How do you think about this?
Yeah, good question. So I guess potentially a good another signal if expected returns are kind of similar across countries. And I guess one could try to incorporate this by maybe not hardwiring that, expected returns are exactly the same, like on the prior belief, starting with prior beliefs, not necessarily that expected returns are exactly the same at a given point across time across countries, but maybe correlated, right? And then one could again treat the correlation kind of as a hyperparameter that one could try to estimate from past data. And then effectively one would be looking at an optimal combination, an optimal weighting of international data and domestic data. If, for example, my goal is to predict US returns, I could then ask, well, could I pull in to some degree international data in an optimal way in order to construct a forecast for US data? So that's how I would think about it.
I'll allow myself to step in, and I think it's difficult to challenge a methodology. It's very reasonable, and maybe I'm getting too philosophical, but it kind of pauses kind of questions about how we do empirical asset pricing going forward in some kind of way, right? I mean,
Right,
if
exactly.
there's no reason to believe that, if it's called them factors or anomalies or whatnot, are kind of persistent through time, then how do we control for do we stay in the factor zoo that we created? Do we get out of it? I mean, what's the role of empirical asset pricing? Are we contributing to market efficiency? Is it's
Yeah, absolutely. I think that's actually a crucial question, right? Because just to give one example, right? If some pattern in the cross section of expected returns is really something that looks like it's kind of constant, it's always there, then it might, for example, make sense to think about, well, is there some sort of macroeconomic risk explanation for this also? If you see some patterns that pop up at some point but then disappear, well,
Hmm.
maybe then it's not worth, spending a lot of intellectual effort in trying to construct some sort of, macro risk-based explanation for this. And actually, the same, I guess, applies for behavioral stories as well, right? Then it wouldn't really make sense to think about or necessarily some sort of, permanent underreaction, overreaction story or something that explains that, right? And so yeah, I fully agree. I mean, there's sort of a broader question there about how we do empirical asset pricing research. And at least in my personal view, I think we have paid so far too little attention to this possibility that, things change over time. And we need to think about that a lot of things are probably changing over time. And so this probably means we need to do empirical work a little bit differently. This is just one example of an attempt to do so, but there are many other ways in which one can try to think about doing this.
Thank you.
So it's striking that all the predictability seemed to disappear around in the early 2000s.
Mhm.
This is also by the early 2000s, I think there were many quantitatively oriented hedge funds populated with people like your co-author
Yeah.
who know how to read the Journal of Finance and know how to code these things. Is that the explanation for why predictability had disappeared around 2005?
Well, I cannot say for sure that it's the explanation, but all I can say is to me, this is a very plausible explanation because I think that's exactly what has been going. What you say is there's lots of investors now trading on those signals. And so one, I think, very reasonable explanation of what we're seeing there is that the low-hanging fruit has been picked. Um, and this was at the time low-hanging fruit, these simple, past return-based anomalies and probably some other anomalies in the cross-section as well.
Hmm. Well, that's very thought-provoking. Anyone else has big philosophical question for Stefan? Apparently, our audience is deep in thoughts. So thank you so much, Stefan, for your presentation. This has been super interesting. Well, we were very happy to have you. And is it concluding our? Oh no, I think we still have another
We